In this lesson, we are going to be looking at a number of different ways to integrate technical indicators and the process of technical analysis with profile concepts. As usual, before we start, I would like you to please review the disclaimer. So as you watch the lesson, pause or stop it for a moment to read this. All right. We will go ahead and get started with the content of the lesson. And as I just mentioned a moment ago, our focus will be on looking at a variety of different ways to begin to integrate some of the profile concepts that we have been discussing with technical analysis. First of all, let me highlight and focus on the fact that the profile simply does not do away with technical analysis. Many traders that are not familiar with the profile think that the profile is a tool that eliminates the need for technical analysis, or that once you understand and use the profile, you will no longer need any of the technical analysis tools. That simply just is not true. The profile adds to technical analysis. It brings a new level of accuracy and a lot of very important market activity data and information about things that are going on to the market that become incredibly helpful when we integrate, and as you will see, when we use those in tandem with or in conjunction with technical analysis. So by no means are they mutually exclusive, or the intent is to use just one or the other. It is a tremendous advantage to be able to have knowledge in both areas, and to combine that knowledge, that certainly gives one an edge over someone that does not have the combination. All right. We've been looking at a number of profile charts, and now I'm bringing us back to the famous candlestick charts. And in this case, I have a 30-minute candlestick chart for the euro-dollar pair. And the next thing we're going to do is we're going to put an indicator on our candlestick chart, and this indicator is really a profile indicator. And it is just a simple matter of putting that profile indicator on the chart. And the indicator automatically will identify for us a lot of very valuable information about what is going on in the market, and it shows us a lot of things that, once again, the candles alone do not show us and do not tell us. Before we begin looking at what the profile in tandem with the candlesticks tells us, let me just highlight the fact that I am using a daily volume profile. And again, I really want to emphasize the word volume profile, because there's a big difference between just an activity profile and a volume profile. Especially since we are talking about Forex, we do have volume data, general data, and it does give us the type of parameters that we want to look at from the profile. If you notice, each of the profiles, I have two daily profiles here. The first one is this one right here, and this is the second one. And each of them have a shaded profile. Now, there are many different ways to display this profile using the indicator, and depending on what I'm doing and depending on the nature of the items on the chart, I may change the look of that profile. Sometimes I really don't want to see all that color. I just want to see hollow blocks. In this case, I wanted to highlight using a volume shading profile, because this helps us to see the volume nodes and where the intense volume actually exists on various price levels. Now, I'll just do a quick review with you. The red color is the most intense volume, followed by orange, followed by yellow, followed by green, followed by blue, followed by dark blue. So the dark blue areas that you see down here, and let's see, in this zone here, and again, once again up here, really are areas of low volume. The red nodes that you see here and here and here, these are high volume. So we reduce volume as the colors move towards the lower of this column. Red being the most intense, followed by orange, followed by yellow, green, blue, and dark blue. So this allows me right away, if I were to look at this profile, I know that I had more intense volume activity in this area than I did in this lower cluster down here. And similarly here, this area did not have a lot of volume, but I began to see intense volume here and also intense volume up here in this area. So this is how the colors begin to help me on my profile indicator. Now let's take a look at some of the other nice things that this indicator automatically does for us on the chart. Right away it identifies for us our value area high. It also gives us our value area low, and notice this is the level right here pointing right to it, and there's the value area low, and of course it gives us the point of control, and this is the VPOC, or the volume point of control, so it's based on volume. Now notice in this case I really don't have the activity volume profile, and I'm not looking for that. Certainly you can superimpose another indicator on top of that and you can show both, but in our case on our chart, I like to keep the charts as uncluttered as possible, as clean as possible, and I don't really see much utility for it on this chart. The kinds of things that we're going to be looking for, we will enhance using some of the technical indicators that we'll introduce, so we're not going to need two superimposed profiles on top of one another. But notice how nicely this helps us to see what's going on once we put the profile indicator on. See the value area high, price attempts to go through it, fails, comes back, drops, finds support at the value area low, bounces back up but never quite makes it to the volume point of control, drops lower and then picks up, comes right back up, back into value, drops back down again, creating a lower low. And by the way, these dotted blue lines always show us the outside range of the profile, the range high and the range low. So this would be the range low, and there's my range high, and these dotted lines outline for me the full range of the day session or whatever profile session I may have on the chart. Another element to note is this magenta color here, and naturally you can change those colors on the indicator should you wish to do so, but whenever I have a naked volume point of control, meaning one that has not been tested, prices have visited it in this area and it hasn't come back to visit it again, it's dashed and in the color magenta. And once again, the dotted line here is the high range for this session, and there is the low range, and you can easily see the value area low, value area high. Now notice for this session it is this line, whereas this line right here, the lower line, is a value area low from the prior session. Whenever you begin to see an accumulation of lines together like this from different profiles, pay special attention to them. These become important price levels in the market. And if you notice, price dropped right through it, came right back to them, and it formed a level of resistance, and prices dropped down once they hit that particular level. All right. Now let us introduce a real simple rule once we have this indicator on our chart. It's a common rule that many profile traders are familiar with, and it's known as the 80% rule. So what does the 80% rule really tell us once we have a profile on our chart? Well, it's quite simple. It says using a 30-minute profile, and note the 30-minute profile is key. When price moves away from value, as it did in this case, see how this was the value area low, so this was my value area. Here are my two parameters, and price moved away from it down to this area. Now, price moves away from value, so it's the first criteria. We need to be on a 30-minute profile. Second criteria, price moved away from value. Okay, what then? What is the next thing that we should be looking for? Price then returns to close for 2 consecutive periods in value. Now notice in this case, price came back, first close, here's my first close right here on this candlestick, and then here is my second close. So we had 2 closes back in value after price had deviated away from value. Okay, so what? Now we have 2 closes up there. Well, the 80% rule now comes into play. And what does it tell us? It tells us that there's going to be an 80% chance that price will test other value extreme. Meaning if we had broken the value area low, we're going to go back for a retest of the value area high, and in this case it did happen as the 80% rule would have predicted for us. Now remember, it is an 80% rule, not a 100% rule. And notice here also, because many market participants know about this 80% rule and can easily spot it, notice what happens. The market dips back lower and then shoots right back up again to really fulfill the 80% rule. This was a shake them move, if you will, and all of the individuals that went long at this point somewhere and left their stop here, they had their stops killed, and yet they were right. They were following the 80% rule, and the 80% rule did hold. Sometimes that does happen. So if you were in fact in the trade, you probably should have waited at least until we took out the high of this candle, which had the second close, before you took a long entry. And if you were safe and waited, you would have not been hurt by this move back lower. Now, when we had this move back lower and we come back up and we close again here, this would have been an easy time to enter, knowing that we are going to eventually make it all the way to the top. Once you see this, this is a nice pattern to trade upwards. And notice the opportunities tend to present themselves when price deviates away from value, as we mentioned in some of our previous lessons. So that is the 80% rule. It's important to know it. It's a basic rule. Now let's go back to the beginning of our focus, which is integrating technical analysis and profile concepts. Well, one of the key things in technical analysis is candlestick patterns. There's a whole art and science, and I don't want you to ignore or take for granted all the things that you've learned about candlesticks. They can be very powerful analytical tools, and they are in fact helpful. Now take a look at how the profile enhances the information that we garner or that we gather and get from candlesticks. Notice we have a very interesting pattern here. Take a look at these 4 candles together, and let me hone in to focus on them a little bit and enlarge them so we can see them a little bit better together and see what's happening. Well, we know that this is a value area high. The first time price comes up to visit that value area high, we get a selling wick, and we end up with a hanging man candle. Well, do we immediately take a short at that point? No. Let's wait and see what happens. The next thing that happens is we get a spinning top, a small little, almost like a doji, if you will. And then we get another hangman, very strong wick from the same point. So it looks like in these 3 30-minute periods, first time price was rejected and rejected forcefully, wasn't able to come back up. There was a 30-minute period of uncertainty. We came back for another retest. The test fails again. And now on the 4th candle, here's what we find happening. The 4th candle, we have a lower high than the prior high. Here, if you notice, consecutively, all 3 candles had higher lows. All of them higher lows. Now, for the first time, we're seeing a lower low, and not only that, a lower high. This would be the entry candle once we take out the low of the prior candle. See the dotted line that I've highlighted here? So once we take out the low of this candle, this would be a good potential entry for a short. We know we weren't able to penetrate the value area high. If we didn't have a profile indicator and we didn't know anything about the profile, well, we have the candlestick pattern and we could still go by that, but look at how much more credibility, if you will, and how much more comfort one would have knowing that that is a value area high and we couldn't penetrate it in taking a short up here. You begin to see the advantages of the profile in action when combined with technical tools such as candlesticks. Okay, now let's take a look at this trade. If in fact we were to execute this particular trade, we would have a nice handsome profit with also a clearly defined risk management parameter. The risk management parameters would be based on our profile. Notice our value area high, so we would place our stop up there. We would enter short as soon as we take out the low of this prior candle, so the entry would be at about 1.2756 with a stop at 1.2770. And now the key question is, where is my target? And this is where the profile becomes incredibly valuable again as we integrate it with our candlestick pattern. Here's my first target. My first target would be my volume point of control, and the level is clearly identified for me, and I'd have a nice about 19 pip trade if I wanted to exit right at that level, the volume point of control. Second target would be this low here, the last lowest low in the auction before we came up and made this move. This would be my second target. If that target is also taken out, my third target would be the value area low. Notice how the profile structure really helps me to structure my trades, gives me clear targets, and I'm going to also share with you how it helps me to manage my trade. If in fact I entered here, as we had talked about, with my short. As the price begins to move lower, I may also want to move my stop once this candle closes to the low, or in this case, the high of this particular candle, since we're in a short. Similarly, as this candle closes, I place my stop at the high of the range for that particular candle. So I could have a rolling stop. And that way I reduce my risk. So now I know if my stop's here, if I wanted to let the trade run, at worst, I'm always going to have something in that trade. And rather than leaving my stop way up here, I begin to gradually move it as the market continues to move. And that technique helps us to capture a longer move in the market. Now, I could also take out a little bit of my position if I had several lots or more, trading more than one lot. Take some out, take some profit out, and leave some to run and bring the stop for it. There are a number of different strategies, and we will talk a little bit more about strategy in our next lesson. All right. Now we're going to look at integrating some technical analysis using a very common and very popular indicator, a technical indicator, if you will. Hopefully you are familiar with the stochastic. It is probably one of the most frequently used oscillators by technical analysts. And so what we're going to look at is a stochastic divergence. Before I talk about the stochastic divergence, let me just take a moment to talk a little bit about the stochastic itself, just in case someone is not familiar with what a stochastic is and how the stochastic generally works. So let's turn our focus to the actual indicator below here. And if you notice, it is, as we mentioned, an oscillator. And what is an oscillator? Well, the idea behind an oscillator is it shows us the oscillations of movement in the market, the cycle, if you will, from top to bottom. So if prices are dropping, then it will show us that cycle, and then as prices begin to pick up, then it will show us that cycle as well. Now, most stochastics on many of the platforms in the market are bound stochastics. Bound stochastics means that they cannot exceed the number 100, so their range is from 0 to 100. This particular stochastic indicator that I'm showing happens to be in market delta, and it gives us the flexibility of being an unbound stochastic. As with all things, there are advantages and disadvantages to an unbound stochastic. I like to use it because it tends to cut down on the number of erroneous readings that you get from it. But nevertheless, you still get some erroneous readings. Now notice, there are some cycles, they seem like very broad, very big cycles, and yet when you look at the price action was very limited, nowhere near the span of the cycle shown on the stochastic. And that's one of the weaknesses with the stochastic. It doesn't always reflect accurately the oscillation of price with the oscillations within the indicator. And I'll show you another example of that weakness in just one moment, but let me at least share with you the settings that I have on this particular stochastic, because those also change and vary from one platform to the next. In this case, on my unbound stochastic, I have a fast percentage D of 8. The setting is at 8 periods, and the slow is at 3. So those are the settings that give me this particular action on the stochastic. Now, Let's talk about the 80 and the 20 on the stochastic. The idea is when the oscillator dips below 20, that means the more it dips and the lower it dips, that means that we should be we're in very negative territory, and we should be looking at a point when prices should start to move back up. And then when we are above 80, that is a zone that's quite bullish, and we should be looking for the other oscillation down. But keep in mind that at times the stochastic will do what you see here, and really what it does here is it stays in the negative territory and flattens for a while, and that often causes individuals to make the mistake of thinking prices are ready to move higher when they're really not, and they're stagnating or they continue to move lower. Notice here in this case where prices are, that the stochastic is really somewhat flat and still in negative territory, and the prices continue to drop lower, but we're not seeing an oscillation to the bottom side. On the contrary, the stochastic is misleading us. Now, eventually, we end up with a little move to the upside, but in this case, it was very choppy, and it didn't accurately reflect the movement lower that we see in the price action. So, I wanted to highlight the weaknesses of the stochastics so that you can appreciate its strength when we demonstrate it next. First of all, we have to have some support from the chart. So we need to be looking at an area where we think there is potential for a trade. So we've approached the value area high. Our candlestick pattern that we described earlier is starting to manifest itself. And then do we get support from the stochastic as well? We begin to have what is often called a confluence of evidence that this is a good entry. So we have divergence, and we also have a crossing of the slow stochastic and the fast stochastic based on the settings I shared with you earlier, from above the 80 or right around at about the 80, indicating prices are ready to drop in this area, in addition to the candlestick pattern, in addition to the fact that we are at the value area high of the profile, the volume value area high. Now, on top of that, we also have a somewhat of a divergence on the stochastic. Let me talk a little bit about the divergence. Notice here, the last peak on the stochastic was here, and the next peak is just ever so slightly higher. But notice how the slope of the price action is significantly higher than what we see on the stochastic and the high up here. This did not move quite to the same extent. Sometimes it will even move either at the same plateau or lower. And that's what we mean by divergence. We don't get the same level or the same extent of movement on the indicator that we see on the price action, and that affirms for us a potential pending change. So look for these divergences. They are helpful in addition to some of the other technical pieces of information that we can garner from our candlesticks and even some of the other indicators that we will look at. The more evidence you have supporting your theory for action and your theory for a trade, the more confidence you will have in taking the trade. And not only that, the higher the probability of success you are likely to have. So if I was looking at the profile alone without anything else, I would have still been willing to take it. But now notice how my technical indicators and the candlestick pattern enhance my level of confidence and add to that level of confidence. So by integrating all these elements together, I develop what is often described as a confluence of evidence for action or for whatever decision that I would like to make as a trader. All right, now we are going to shift gears and introduce another important technical indicator that I like. I like this particular indicator, the VWAP, or the volume weighted average price, for a number of different reasons. First and foremost, I like it because I know that many professional traders and institutions do in fact use this indicator, which makes it incredibly valuable because it helps me to look at the same type of information that the major market participants are looking at. And now keep in mind, when you are trading in the Forex market, the major participants are all professionals. You're looking at central banks and major money institutions in the Forex market. So the VWAP then takes on special significance, and I will show you momentarily evidence of that. Well, what is the VWAP? If you're not familiar with the VWAP is calculated by adding up the dollars, or the money, the amount of money traded for every transaction, which means they take the price, they multiply it by the number of units traded, and then divide it by the total units traded for the day. We're trying to sort of find the volume weighted average price. The general theory is, if you are buying below the volume weighted average price, you're buying at good prices. If you are selling above it, you're selling at good prices. That's a very primitive explanation of the VWAP. Let me share with you some better ways to use the VWAP. Now, once again, I have my profile indicators on the chart, and in addition to the profile indicators, I have the VWAP shown as a step line. And I like the step line because it helps me to see incrementally the direction of movement of the VWAP itself. You can almost see the steps. It's very easy. For instance, if I looked right here in this area, right here, I can see how the VWAP, the steps are moving lower, is stepping down, if you will. And at the same time, when I take a look at my value area high relative to where my VWAP is, if I begin to see, and when we talk about the bands, this will become far more evident, how far am I from the VWAP? Remember, again, the closer you are to the VWAP, the safer you are, in a sense. And the general idea is, when you're far away, if you buy, you are buying at better prices, and if you are selling above the VWAP, you're selling at better prices. But notice also how the VWAP, as it changes direction and steps down or steps up, gives us a good overall indication about potential direction in the market. And notice also how each of these 30-minute candles continues to close below the VWAP, indicating negative pressure to the downside, and prices continue to move lower. Periodically, they will come back for a retest of the VWAP. This often happens, you will see, or you will find, especially when the VWAP and the VPOC, the volume point of control, come together. Prices, that becomes a magnet for prices to test that zone. On this chart, I have included, in addition to the VWAP bands. And these bands are part of the indicator. You can select or deselect them. You can also, if you wish, add to them, add more bands. The standard, or the typical VWAP, comes with 3 levels of bands, each of them at about 1 standard deviation away from the actual VWAP. So you have one level that will be at 1 standard deviation above the VWAP, as we see here, and then you have another level that will be 1 standard deviation below the VWAP. And the calculations are made automatically by the indicator, and it will show it right away on the chart. Now, these bands are very, very helpful because they help us with two key things in monitoring price action. The first, they show us how far away price has deviated from the volume weighted average. Is it one standard deviation, two, three, and so on? And the second, which is a more advanced use of these bands, is engaging momentum in the market. And I will talk about both of them. First of all, let's talk about how far price deviates from the VWAP. Well, the greater the standard deviations, the less likely participants are inclined to continue pushing price in that particular direction. And let me explain what we mean by that, but let's first take a look and identify our other levels for the bands. Second level of the band, right here, level 2, two standard deviations away. So the first one right here was level 1 and level 1. Then we have the level 2, level 2. Make sure you can identify them. And the last level that we have simply is level 3, the most extreme that I have on my chart. And there is the other level 3. That is 3 standard deviations above the VWAP, 3 standard deviations below the VWAP. Now, notice what happens when price actually comes to visit these extreme levels. And this is the point that is very, very important. Look here what happens. Well, when price got outside of the 3rd standard deviation, and interestingly enough, it happened to be right at the value area low, price pops back right up. And we get a retrace to the upside. Now, how far up did it go? Well, it certainly penetrated through the 2nd standard deviation and made it to the almost to the 1st standard deviation. This reveals something else that's interesting. Since price in the retrace did not manage to make it all the way back up to the actual VWAP, then momentum to the downside is still relatively strong. If in fact momentum was weakening, we would have begun to see a retrace that should have arrived to the VWAP itself. So notice what happens. We continue to move lower and we pierce through the value area low. Now, what happens when price comes back at the 3rd standard deviation for the 2nd time? Now notice here, 2nd time we visit the 3rd standard deviation on our VWAP. Once again, price pulls back up and continues to move higher. We make it through the 2nd standard deviation, and then we make it again through the 1st standard deviation. We make it all the way up to the actual VWAP. Right there. Now, naturally, you can change the color settings for these different bands. I'm using the darkest color for the VWAP itself, which is black, and then I have red for the 1st standard deviation, green for the 2nd, and orange for the 3rd. Now, notice how on this 2nd retrace up, we do make it all the way up to the volume weighted average level itself. We drop back down, and this is the 3rd time that we actually come down to visit the 3rd standard deviation. And now look, we already knew that momentum to the downside was fading because of the extent of the pullback that we saw all the way to the VWAP. So when it came down here this time, this would have been a beautiful buying point. I would have definitely been a buyer. Using this indicator and understanding that momentum was to the downside was really weakening, and this is our third time to visit the third deviation band. Not only that, notice what is happening with the bands. Notice how the stepping has to some extent flattened, and not only that, they even started to head higher. So this is how you capture some magnificent trades and pick up very good price points. Really pick it at the prime point. Individuals that are not familiar with the VWAP and of course the profile miss out on many of these nice opportunities. So now we pop right back up in that 30-minute period to the VWAP, and we close above it, and we continue to move higher. And notice we make it all the way up to the second standard deviation above the VWAP. But notice our rules about momentum again. First time we drop, second at the second time we come, we drop. What does that tell you about momentum to the upside? Weakening. It's no longer strong. It's no longer a strong move upwards. And sure enough, take a look what happens in the following day session as we notice that momentum has decreased. Prices continue to fall and to drop. And we don't even come back up for another test of the value area high. We continue and we break lower right through the value area low. And notice how my VWAP continues to slope down and step down gradually. It continues to move lower and lower until take a look at this retrace at this point here when we visit for the first time when we visit here below the third standard deviation. We move back up, but notice we come back to close, but we don't close below it. And then we come back down, very weak again, continues lower, momentum is strong to the downside. Now, here we begin to see a change. Price lifts up through the second, through the first, all the way up to the VWAP itself. Now notice, on the second iteration it comes down and only makes it to the second standard deviation. Comes all the way back up, hits the VWAP itself, closes above it, and continues for a retest, and here's where the profile comes in handy. A retest of the value area low of the prior session and the value area high of the current session. In addition to that, we have the first standard deviation of the VWAP. Remember what I mentioned a short while ago about confluence of evidence, confluence of indicators together. All these form a level of resistance and show me that we could not sustain the momentum to the upside. We continue to have lower lows, and when price takes out the low of this period and closes below my volume point of control, I am comfortable taking a short anywhere here. And notice it continues to drop all the way down, and it closes down here, continue below the standard, third standard, continues even lower, and this is why you should never jump in to buy it the minute it drops below the third standard deviation. You should wait until you begin to see a green candle moving and closing higher for a retrace. This is the famous falling knife. You want to be on the right side of it. You don't want to be ever trying to play against it. So when you have these big huge drops, be careful. Don't get hasty simply because it is below the third standard deviation. You want to act and just pick up price to buy. Wait until you have a clear indication that at least you're going to get a retrace, and that really begins down here. We begin to see this green candle take shape, and then here prices are picked up above the third standard deviation, and sure enough we get a retrace. Now the retrace seems to have found the first standard deviation of the VWAP as a support level. Notice how it's resting on it. This isn't haphazard or a coincidence. This is because the major players in the market do use the VWAP. These parameters are important. And sure enough, once again here, we were below the third standard deviation and also below the value area low of the session. This was a good buying opportunity. Here, once again, this was another good buying opportunity, even though it was above the third standard deviation. And sure enough, they picked it up, took prices a little bit higher. And notice what is also happening here, which I pointed out on the earlier profile, the flattening of these lines, the VWAP itself and the standard deviation lines. So at least the directional momentum has been stymied or has been stopped for a period. It may continue again, but we will need to wait and see. The VWAP is a very powerful indicator, and I encourage you to take a close look at it and integrate it into your trading. Now, another useful technical indicator that is very easy for us to integrate with our profile is the directional index. And I have the directional index here below the chart. Naturally, as with all indicators, the settings and the look of the indicator will vary from one platform to the other. This one is based on an 8-period setting, and it's just the standard directional index indicator in the market delta platform. Now, the directional index indicator is really a complex indicator in terms of the calculation, and I'm not going to get into it. I really want to briefly describe for you what it is and how it works and how we can use it, rather than to get into a lengthy calculation or formula. And most platforms will do that automatically for you anyway. The directional indicator has really two components to it. There is a positive directional indicator and a negative directional indicator. The positive DI measures the strength of the upward trend, or the momentum of the upward trend, while the negative DI, the negative directional indicator, measures the strength of the bearish or downward trend. So they're really opposites of one another. Now, as a basic, simple rule, in this case, I have the positive directional index in the color green and the negative in the color red to highlight a bullish trend and a bearish trend, if you will. General basic rule: whichever one is on top is the dominant one. So in this case here, because red is above the green, then stands to reason we are in a negative or a bearish trend. And sure enough, if you look at prices, they are dropping. Once again, we use the indicator in tandem with opportunities that the profile helps to identify for us. So we get our first cue from the profile, and then based on that, we begin to take a look at our technical indicators, one or more of them, and you can pick whichever one you like, and then use them to help us make our decision. So there are two areas that I want to direct our attention to on this chart to demonstrate the ease of use and how the directional index can be helpful for us. The first, we've looked at this example with a number of different indicators, and we'll look at it again. We've got the candlesticks in our favor. We've got the profile value area high. Now take a look at what is happening with the negative or the minus directional indicator, the red line here. It is creating a V shape. It was first dropping, now it is starting to rise. That is telling me that a bearish trend is about to get started in tandem with my candlestick pattern. Not only that, what is happening to my positive DI? Well, it dipped and it took another dip, and it is starting to drop as well. Beautiful setup, confirmation of what I'm seeing up here, and sure enough, the negative directional indicator shoots up higher as prices precipitously continue to drop. Well, we get to an area of hesitation here, and it looks like consolidation, and possibly we may be heading back up. But take a look. Even though the negative directional indicator is sloping lower and dropping, the positive one is nowhere to be found. It's sloping lower also and dropping. So there's nothing here to tell me that prices are going to start rising. Prices will continue lower, and sure they do. So simple use of this directional index helps me to stay on the right side of the market and not to make the mistake that I may have a retrace or a reversal at a point when I don't have it. The best points to try to identify are points where you have two opposing V's. Like, for instance, in this area here, we could see it. The negative was starting to rise higher, and the top green was dropping lower, but notice, prices continued higher because who's still on top? The green is still on top. So this keeps me on the right side of the market. As long as the green is above the red, even though I may be detecting an increase in the negative pressure, this is still significantly above, and the bulls are still the dominant force. When you begin to see the indicator intertwine as we do in this area like this, this is usually typically an area of congestion, and you can see it in the price action as well. There's really no direction, no clear, coherent direction to be determined, and you probably want to stay out. And ultimately, you want to remember, you want to take your cue from the profile. So here, once again, if I were to ask you, is this a good point for a short or a long? We're coming up on the value area low in the profile. It should be evident from the directional indicator that you should continue with a short, because the negative directional indicator is still significantly higher, and this one is still pointing lower. A short would definitely be in order. I hope these examples have given you a coherent picture of a number of different ways to use technical analysis, technical indicators with the profile. The more versed you are in technical analysis, the more examples you are going to be able to integrate and bring together with the profile. With that, we will conclude our lesson, and I will see you in the next one.